We are going to move from a resilience to a natural brilliant state.
We're all here to move our Black communities forward.
We think our children have to have the best. It's all about discipline.
How are we going to discipline ourselves so that we're able to save, so that we're able to make good financial decisions?
Recognizing that there's a road ahead if you manage the road in front of you.
The decisions that you're going to be making today in your lives where it comes to money will affect you in the future.
Discipline is one of the things that we often learn, sometimes by our environment, or sometimes we're forced to do it, and sometimes we don't learn it at all.
Stores want to get us in and out and get our money, and that's it. It's a game, so you have to be really wise to the game.
Do you know what it costs to run your home on a monthly basis?
Land acknowledgement. As we gather together, we acknowledge the sacred land on which we reside. It has been a site of human activity for 15,000 years. This land is the territory of the Huron-Wendat and Petun First Nations, the Seneca, and most recently, the Mississaugas of the Credit River. The territory was the subject of Dish with One Spoon Wampum Belt Covenant, an agreement between the Iroquois Confederacy and Confederacy of the Ojibwe and allied nations to peaceably share and care for the resources around the Great Lakes. Today, this gathering place is still the home of many Indigenous people from across Turtle Island, and we are grateful to have the opportunity to work in the community on this territory. We are also mindful of broken covenants and the need to strive to make right with all our relations. Last but certainly not least, we acknowledge the people of African descent who were brought here against their own will or in search of a safe place to live their lives and raise their children. Reconnaissance des terres. En nous rassemblant, nous reconnaissons la terre sacrée sur laquelle nous résidons. C'est un site d'activité humaine depuis 15 000 ans. Cette terre est le territoire des Premières Nations Huron-Wendat et Petun, les Séniques et plus récemment les Mississaugas de la rivière Crédit. Le territoire était sujet de l'alliance de la ceinture Wampum plat avec cuillère, un accord entre la Confédération Iroquois et Confédération des Ojibwe et des nations alliées à partager et à prendre soin pacifiquement pour les ressources autour des Grands Lacs. Aujourd'hui, ce lieu de rassemblement est toujours le foyer de nombreux peuples autochtones de toute l'île de la Tortue et nous sommes reconnaissants d'avoir la possibilité de travailler dans la communauté sur ce territoire. Nous sommes également conscients des alliances brisées et de la nécessité de nous efforcer de guérir toutes nos relations. Dernier point, mais non le moindre, nous remercions les personnes d'ascendance africaine qui ont été amenées ici contre leur volonté ou à la recherche d'un endroit sûr où vivre leur vie et élever leurs enfants.
This webinar provides illustrative information with respect to the subject matter covered and does not represent an official opinion or position of the Black Business and Professional Association. The BBPA makes no representations, warranties, or guarantees as to assume no responsibility for the content or application of the material contained herein, and especially disclaim all liability for any damages arising out of the use or reference to or lines on such material.
And a beautiful good morning to you and yours here on Community Space. Welcome. Great to see everybody. And as we always say, tell a friend to tell a friend. It's not too late to join us.
Never too late.
Community Space, the financial literacy program that speaks the language of the community. How are you this morning, Tika?
I'm great, Rod. It's raining outside, but I could do with a little bit of rain. And we missed you last week. Welcome back.
Yes, I was actually with the BBPA had a members, a board meeting, I should say. And I was trying to get on in terms of the Wi-Fi and whatnot, but it wasn't cooperating. So
it's okay. It's
I was listening in when I did get a chance, but I didn't bother jumping in to interrupt.
Yeah, no, that's okay. It was a great session last week. As always, I think Professor Annisette is making accounting very exciting. You know, I avoided accounting as a subject in high school. Blame that to having a parent who's an accountant. But if I knew it could be this exciting, I think I would have dabbled a little bit. So welcome, Professor Annisette. It's good to have you for week 3.
Absolutely. And before we get to Professor Annisette, that parent who's an accountant also is a board member, and he's actually introduced me to the wonderful.
Oh, you muted yourself.
Sorry about that.
There you go.
As I said, he's introduced me to the wonderful world of accounting, and in terms of just the meticulous nature and how comprehensive he is, I'm actually liking it. I'm enjoying it. So I look forward to this opportunity. And on that note, I think it's something that we would want to talk about is when opportunity knocks, you take advantage of it. You answer that door, right? So whether it be accounting or anything that can help your trajectory go in the direction that you want it to, we definitely encourage you to answer that door, take risk, calculated risk that will improve the quality of your life and those around you. So accounting, obviously, when it comes to business, is a no-brainer. You have to have some accounting knowledge or have somebody who has that within your corner to have a successful business. So answer that door when it knocks. So take advantage of these opportunities. Again, tell a friend to tell a friend. And on that note, Professor Annisette, how are you this morning?
But I'm fine this morning. I'm still smiling at tickers because I could relate to your dad. I went through the same thing with my own son who resisted accounting. But he logged in last week. He came to his senses.
Oh, great!
At the age of 29, and he may actually be logging in this week again. So eventually.
Yes, that's fantastic.
You guys come too.
Yes. And so for the business owners or just folks joining us today who have young people who are considering what life path they could possibly take, maybe accounting is an option. Here we go. And next week, just a short plug for the 2 weeks that follow this. So next week, I'd broach this with Professor Annisette prior, but I would love to have a conversation with you about what your experience has been as a woman of color, as a Caribbean woman in accounting, both as as a practitioner, but also as a professor. And I know in week 5, you're putting together a nice little panel for us to go beyond sort of the content you're sharing. So join us for the next 2 weeks and tell a friend to tell a friend, because I think it will be really exciting what we're gonna discuss. And so without further ado, over to you.
Okay, thank you. Of course, I always fumble at the beginning with screen sharing. So may I have screen sharing? Good, that helps. And the second thing for me is which screen? Perhaps this is the screen I should be sharing, and maybe I should be going back. So give me a couple of minutes. Let me get my act together. As I said before,
we can see your screen though.
I think it's the wrong screen though. So let me, are you now seeing sort of my opening screen?
Yes.
Okay, great. And I'm going to move ahead very quickly. I'm going to try to move ahead very quickly today and not be as interactive as I have been before, because I'm way behind where I'm supposed to be. And I did, as Tika has said, plan to bring a panel for the last session. I would be bringing a tax expert who has agreed. He is a colleague of mine. He teaches personal tax both at the Schulich School of Business and at Osgood Law School. I know many people have been asking questions about tax. I could talk about it, but since tax is not my area of expertise, and I have a really good colleague who teaches tax and for whom this is his area of expertise, I just, let me bring him along. I'm also wanting to bring along my nephew-in-law, who is a financial analyst and advisor. And when I, so Tika, we have to talk about the next session, because I also wanted to talk about cash management, and I wanted to bring him in there. So, it will be a mix of things next week, cash management and something about my own personal experience. And then in the last week, I will bring in the tax expert. As I said before, I sort of changed what I would have done the last week, because it was clear people wanted to know much more about tax. So for that reason, I'll be doing a lot of talking today and not the participants. What I want to do is, effectively just complete our understanding of building and destroying personal wealth, and use those understandings to better grasp how wealth and wealth building and wealth destruction is represented in financial statements, in company financial statements. So first we look at our own individual selves as though we were a business. As I said, the aim to, to highlight certain concepts so that we have a really good understanding of those concepts, because it's the same concepts we're going to use and transpose to understanding financial statements. And because we are all in Canada and have a sense of what is going on, I've chosen to sort of build the latter part of the session around the financial statements, the current financial statements of Air Canada. So let's pick up where we left off. Where we left off last week, we're looking at two balance sheets, really, one for Adrian and one for Brenda. And even though we all agreed that Adrian had far more net worth, remember we started this series with grappling with the idea of net worth, even though Adrian had greater net worth, more than 100%, 150% more than Brenda, we felt that it mattered. The constitution of his assets mattered, the constitutions of his liabilities mattered, and we ended up saying that perhaps Brenda's balance sheet was preferable, given the nature of her assets and liabilities, than Adrian's. Before I sort of go in, and what I intend to do is go through about 3 scenarios, looking at Brenda and Adrian to bring out certain, truths and core concepts. But before I do that, I just want to make a point that perhaps hasn't been made before, but it's an important point: what a balance sheet is. And a balance sheet is a statement of wealth at a particular point in time. And that's really important, that last sentence, at a particular point in time. It's like a snapshot. So here we are looking at that snapshot of assets and liabilities, net worth at a particular point in time, and that particular point in time is the 1st of January 2021. And any balance sheet that you look at for any entity, be it an individual, a company, a cooperative, it will always have a date at an instant in time. This is what the economic entity looks like at that date. 2 days later, it may look different. So always think of the balance sheet as a snapshot. So let me move on. As I said, we decided that Adrian, even though he had more wealth, greater net worth, might not be as desirable as Brenda's. So let's see what happens during the year. And let's make a fairly unreasonable assumption, but for the time being, we will go with that. Let's assume that neither Adrian nor Brenda do anything for the year. They're in a coma, right? But what happens during the year, as we have experienced, the property market goes crazy and it experiences a 20% increase in value. Okay, and all of us have seen how the property markets everywhere we live has skyrocketed during the year of 2020. So that's not an unreasonable assumption. In fact, the only thing unreasonable here is the 20%, because in some markets it's even more than 20%. Cars typically lose something like 50% of their market value in their 5 years, in 5 years of owning them, and typically about 20% of their market value. As I said before, a car is an asset. As you drive out of the dealership, it loses value. So let's assume that because this is not just a regular car, instead of losing the typical 20% value, Adrian's car only loses value of 15%. And as I said, assuming nothing else happens during the year, neither Adrian nor Brenda do anything during the year, what is their wealth, what is their worth at the end of the year, just on account of these changes in market value of their assets? You will see, as I said before, all property experiences a 20% increase. So for both Adrian and Brenda, their homes experience a 20% increase. Their both homes increase in value by doing nothing, from 600,000 to 720,000. What that means is, if they both decide to sell their homes at the end of the year, that asset 600,000 can convert into cash 750,000. Adrian's sports car loses value. It loses 15% of the value, which is typical, as I said, by the end of the year. So the value is no longer 400,000 what he paid, but it is now 400,000 less 15%, which is 60,000. So his value, the value of that sports car, goes down to 340,000. I am not dealing with liabilities. I'm just dealing with the impact on wealth due to just changes in the value of your assets. You can see, however, that for Brenda, rather than investing in a sports car, she invested in a rental property. And that rental property, though at the beginning of the year, had the same value as the sports car, by the end of the year, whereas the sports car has lost value, Brenda's rental property has also experienced the 20% appreciation. So it's now increased in value from 400,000 to 480,000. What has been the impact on net worth? You can see the impact on net worth has been significant. Brenda has been able to double her net worth. Actually, her net worth has increased from the beginning of the year from 200,000 to the end of the year, it's 400,000. And note, in red, it says balance sheet, Brenda and Adrian, as at the 31st of December. So again, it's a snapshot. So we looked at Brenda and Adrian. It's like taking a snapshot of their financial position at the beginning of the year. We've taken a snapshot of their financial position at the end of the year. And we see, yes, both have increased their net worth, both have increased their wealth on the basis of the same stock of assets that they started at the beginning of the year. Brenda has outperformed Adrian because of the portfolio of assets she has had. So, you know, I guess the big takeaway here is that appreciation in the value of assets increase wealth, and depreciation in the value of assets decrease wealth. So the nature of the assets that you have is really important about wealth building. And as I said here, neither Brenda nor Adrian have done anything during the year under this assumption. In both cases, their wealth has increased, as I said, more in Brenda's case than in Adrian's case, by doing nothing. That's why I call this passive wealth building. The asset is just increasing in value, and your wealth is increasing in value just because of market forces. Let's move on to scenario 2, which is a little more realistic and a little more complicated. So I'm going to start again at the beginning of the year. I'm not going to deal with what is called capital appreciation. I am now going to deal with something that Tika sort of pointed to, I think, in the first class, about how you behave, your own behavior, action, activity, which in this case I call building wealth through operations, or active wealth building in terms of your lifestyle, in terms of your activity towards wealth creation. So let's go back again to the beginning. The initial balance sheets of Brenda and Adrian. These are balance sheets we left with last week. Same asset base, same liability base, same net worth at the beginning of the year. In this more complicated scenario, what I want to include is earnings activity. And let's say at the beginning of the year, 1st of January, as I said, they started off with their stock of wealth, and at the beginning of January, they both get jobs. Adrian in fact, gets a better job offer than Brenda. Adrian's got a job offer that's offering $80,000. And I'm just going to call this after tax, right? $80,000. That's his salary after tax for the year. As you can see, Adrian has a bit more flamboyant lifestyle than Brenda. His living costs, his cost of living, you know, he does more dinners, you know, going out for dinners and so on. So his living costs are higher than Brenda's, almost twice. Of course, he has a very expensive asset, which is that motor car, which is high maintenance. So the upkeep of that car itself cost him $15,000. The other thing that we spoke of last week was the nature of Adrian's liabilities. And here we are seeing how his liabilities come to play, the role of liabilities in your operational activity. He had credit card liabilities, and we know credit cards are really expensive, and we spoke about why credit cards are an expensive form of financing, 20% interest. So you can see here the interest on his credit card alone, and you got to pay the interest on the credit card, was an outflow of $20,000. And the line of credit, which is definitely a better source of financing than credit card. It may not be as good as a mortgage, but it's still better than the credit card. The line of credit, even though the principal sum, how much he's owing, is far more, 4 times more than the credit card, the interest is lower because the line of credit attaches typically to an asset. It is secured borrowing. So I think I have like a 3.75% interest on that line of credit. When we go over and look at Brenda's, you know, as I said, less flamboyant lifestyle, the property, that might even be a lot to say that just the upkeep, the property is 8,000, but I'm just throwing figures there. And of course, she has two very low risk liabilities: the mortgage, low risk, low interest. I can't remember, that's probably 2.5%. And of course, interest to her parents, her parents are being very generous. Okay. And most importantly, that rental property, apart from the fact that in the last example, it appreciates in value, it is a rental property, so it also brings in income. So rental income, I think I have in my assumptions there, $1,500 a month, which, depending on where the property is, that is really lowballing. It could even be more. So anybody wants, Tantika, again, you could look in the chat. Tell me what the savings for Brenda would be for the year and the savings for Adrian for the year based on these assumptions. Who goes first?
It's quiet. You can post the response in the chat or raise your virtual hand if you prefer. I guess for everything, there won't be any savings.
Yeah, and for Adrian, you can say negative savings, right?
Yes.
Effectively, that's what negative savings are, that you have.
-550,000.
Yes, so Adrian has spent more than he has earned, right? He has earned 80,000, but he spent 85,000. Whereas Brenda has earned 93,000, which is her salary, 75,000 plus the rental income of 18,000, and she has spent what that looks like, 43,000 she has spent. So question, that negative savings of Adrian, where does that end up? Okay, you spent more than you earned. Where does that show itself?
On your Visa or MasterCard.
Exactly. Exactly. It shows itself on that credit card, right? So let's look, therefore, so those are the responses. And let's look, therefore, at the end of the year, just the impact of activity on their savings patterns or lack thereof of Adrian versus Brenda. Let's look at what their balance sheet looks like at the end of the year. You can see by spending more than he's earned, Adrian's credit card balance has gone up by that $5,000. By saving, which is spending less than she earns to the tune of $50,000, Brenda now has $50,000 cash, and her net worth increases by the same $50,000. Brenda need not necessarily keep that cash in a bank account or in a mattress. She could have actually taken that cash and paid off the mortgage by $50,000 or paid off her parents by $50,000. In so doing, it has no impact on her net worth, because what happens is, yes, her total assets will go down by $50,000. Her total liabilities will also go down by $50,000, leaving her net worth unchanged. So the moral of the story here is that savings during the year increases net worth, whereas negative savings decrease net worth. Here we have two balance sheets for two individuals at two different points in time. One at the beginning of the year, 1st of January, and one at the end of the year, the 31st of December. And we could just look at the changes in the net worth of these two individuals and abstract from that what have been their savings patterns. Because an increase in savings always increases your wealth by the extent of the increasing savings. So this helps us understand the relationship between savings and wealth. And in fact, it is the basis of understanding the relationship between a company's balance sheet and its income statement. Because an income statement explains what happens during the year. It's like that savings, you know, that statement where I showed the activity. What happened during the year? We earned this, we expended that. And the balance sheet at the end of the year explains the result of that. So effectively, a balance sheet at the beginning of the year with an income statement that tells you what happened during the year leaves you with a balance sheet at the end of the year that is explained by the income statement of what happened during the year. This is what we did during the year. This is how we have, in Brenda's case, an increase in wealth, an increase in net worth, and in Adrian's case, a diminution in wealth. Let's move on. Let's bring it all together, because there are really two examples here of how wealth can be built and destroyed through, you know, just passively, through asset growth or asset diminution, market forces effectively, plus how wealth can increase or be decreased through operational activity. That is through the matching of income and expenditure during the year over a period. So let's go back to those balance sheets with which we are familiar, the initial balance sheets of Adrian and Brenda at the beginning of the year. We are familiar with these balance sheets. They're the same balance sheet that I've been using since last class. What has happened during the year? We saw from the first scenario, total asset growth of Adrian was just 60,000. That's, you know, the property went up by 120,000, but the car went down by 60,000. Total asset growth for Brenda was 200,000. Her house went up by 120 and the rental property went up by 80. In the second scenario, we worked out that Adrian spent more than he earned by the tune of 5,000, whereas Brenda spent less than she earned by the tune of 50,000. So this is now bringing it together. And by the end of the year, you can see the impact of these two types of wealth building or wealth diminution, destroying activities, the impact on the various balance sheets for Brenda and Adrian. And as you can see, you know, Brenda has increased her net worth by 250,000, whereas Adrian has only succeeded increasing his net worth by 5,000. Am I right there? No, 55,000. And that would have been the total asset growth of 60,000 less the activity, which has eaten into that of 5,000. And again, it really doesn't matter how the assets are transformed or the liabilities are transformed, the net worth would remain the same. Now, transforming your assets and liabilities can change your potential for increasing or decreasing your net worth. But at this point in time, regardless of how these assets and liabilities are constituted and reconstituted, the net worth remains the same. And I just want to emphasize that point and make that point clearer. As I said before in the last example, it doesn't matter what Brenda does with this cash. She can keep it on December the 31st, or she could take the cash and pay off one of these liabilities. It doesn't change her net worth. It means if she does that, next year, it will have a better impact on her activity because her interest is lower. At the same time, if Adrian had come to us for advice and said, things are not looking good, we could look at Adrian and say, Adrian, things are not looking good for you. And Adrian may say, well, how can I confront 2022 without suffering this likely diminution in my net worth due to my activity, the savings activity? One of the things we may want to suggest to Adrian is to see if he can convert that credit card debt into a line of credit. As you saw before, the credit card debt, even though is one quarter the value, he's borrowed a quarter of what is on the line of credit, the interest on the credit card debt was even higher. So if he could convert that into a line of credit, he would significantly reduce his interest payments, and therefore that would have a significant impact on his savings profile. And in fact, he might be in a savings, in fact, he will be in a savings pattern rather than a negative savings pattern. Of course, you could say, you got to downgrade your lifestyle. Probably you should not be going to, dining out every night. Probably, you can, you need to practice some degree of financial discipline. So, there are a number of options. If your income, of course, you could say increase your income, but how? There's sometimes there is, limited control we have over that income line, and therefore to increase our savings, it's the expense line that we have to take care of, and that's where it goes to just now, Roderick. Reducing your lifestyle, right? Downplaying your lifestyle, or going to your balance sheet and saying, see if you can refinance those liabilities, or sell off some assets. This car is eating into your wealth. Okay, so there are a number of options available to Adrian. Yes, Roderick.
Also, as an option, people may not be aware of that you can apply for a line of credit in and have the Visa or MasterCard capability, right? So obviously the credit card gives you that easiness in terms of accessibility and tapping and paying and going, right? But obviously the interest rates are very high, but you can get a line of credit with that same credit card capability, which obviously will give you a lower range of interest.
Thank you. Thanks a lot, Roderick. So I just want to end here with certain important takeaways, because we're going to move from here directly into Air Canada's financial statements. and remain with financial statements of a company as opposed to personal. But I think, again, you know, I want to bring out certain core principles. One, again, to repeat, is a balance sheet is always like a financial picture. It tells you at a particular date, and it talks about wealth. That's what the balance sheet is, a statement of wealth. And that wealth is always that residual figure, assets minus liabilities, net worth. And as I said, there's a different way you could look at a balance sheet and say, okay, these are the assets, this is what the individual owns, these are the things that they have. And on the other side, this is who financed it, right? So you could, you know, there are two interpretations one can put to a balance sheet, right? One could just look at the owner's stake in it, wealth, but also one could look at the relative financing, you know, who finances more. Or, and when I say who, whether it's third parties, which are liabilities, or the owner. So that's one about balance sheets, right? So we have two sets of financial pictures for these two individuals at two different points in time. And two, when you look at a balance sheet and you're looking at this residual figure, which is net worth, changes in net worth between two balance sheet dates, the 1st of January and the 31st of January, in both cases, are brought about by two things. One, changes in the values of the assets, and two, operations. Operations that took place between the two balance sheet dates. Changes in the value of the assets that took place between the two balance sheet dates. So we can look at what's in this segment here, and are you all able to see my cursor moving about? No? Are you seeing this? Okay, so you could look at, you know, this section here as an explanation as to what happened during the year. This says, okay, this is the situation at the beginning of the year. This is what happened during the year. And the end of the year is the result of what was the beginning of the year, what you did during the year. So here we are at the end of the year. Any questions before I move on? We're in good timing, so I'm going to move on now. And I want to bring, therefore, all of this to understanding financial statements, company financial statements. And I am first now going to look at the balance sheet of Air Canada. One of the things, the major shift that we have to make when translating now from personal wealth to company wealth is the word equity. In company accounts, generally, rather than using the word net worth, the word that is used is equity, but it's exactly the same thing. So for individuals with wealth, we call it net worth. For companies, it's equity. So as we said, the three components of wealth are your total assets, your total liabilities. The difference between the two is the net worth. Anytime you have a set of company accounts, therefore, that's what you're looking for. You're looking for what's the total assets. And I took, you know, I downloaded this from the internet. So I didn't, this is not manufactured. These are actually Air Canada's financial statements, most recently published financial statements. And again, you can see the balance sheet is at a particular date. In fact, there are two balance sheets. There is Air Canada's balance sheet as at the 31st of December 2020. That's like a financial picture of its worth, of its wealth at a particular point in time. And then they have produced next it the comparative balance sheet 3 months later at the 31st of March 2021. And I'm using the figures, the 31st of March 2021. So you see already what your eyes should be going for first is for 3 components. Well, 2. One is derivative. 1, what's the total assets? 27,464,000. Yeah, these are in million. So I'm just gonna, you know, get rid of some zeros here. So 27,464 million, really. That's the total assets. What are the total liabilities of Air Canada? That's what you should be looking for. 26,560 million is the total liabilities. Already, you can see that Air Canada, most of its assets are financed by liabilities. And of course, net worth, as you have been taught, or now equity, is that figure there, which I have highlighted in yellow, which is 904. And within this statement, and you know, we're not going to go overly complicated. Within this statement here where it says shareholder equity, it really captures some of the things that I was talking about. To what extent the equity, the change in the equity is brought about, or the change in net worth is brought about by changes in the value, market value of some assets, and changes brought about by operations, savings, or in a company accounts, it's called profitable operations, or negative savings, which in a company accounts are called losses. I think I just want to bring out some key features of the balance sheet. Key is that you should expect, knowing what Air Canada is, that its major asset would be the airplanes, and that's here in the balance sheet under property and equipment. And you would see that constitutes close to 50% of Air Canada's assets. So these are things you start to look at. Okay, now we know what total assets are. Let's now start to look at the composition of the assets to give us a sense of what's going on in this company. Similarly, we know how liabilities are. Liabilities could, are not necessarily bad. As you saw in Brenda's case, she had far more liabilities than Adrian, but her liabilities were not high-risk liabilities or costly liabilities to her. So you want to now look at Air Canada's liabilities, and you see major liabilities is long-term debt and lease liabilities. That's 11,112. And in fact, there are 2 of them that you would want to look at, which bring us to about 17,000 current portion of long-term debt and lease liabilities, long-term debt and lease liabilities. That relates to the financing, largely the financing of those airplanes. So that there are other types of liabilities, but what makes it not as worrying is the fact that these liabilities are long-term. They are not immediately due, because if they were immediately due, what you want to do is look up and say, well, how much cash does Air Canada have? Does it have sufficient cash to pay off the liabilities that are immediately due? What other assertions we can make effectively, just looking at Air Canada's balance sheet, we can therefore make an assertion and use a term that is often used in finance, which is leverage. And leverage talks about the relationship between external financing, third-party financing, and financing from owners, shareholders in this case. The shareholders' equity section really relates to the ownership stake in the business. So we can say Air Canada's assets are highly leveraged. These assets here of 27,000 are highly leveraged, meaning they are largely financed by liabilities and not by the owners. Let me move on to the income statement. Sorry.
Before you move on, you're going to the income statement. I was just looking at the balance sheet and I saw that the deficit increased. But I suspect now you're going on to the income statement.
So why the deficit increase? And I think that's an important point that I should have brought up, because to backtrack in terms of, and if you think about, Air Canada's balance sheet looks very much like Adrian's. You remember Adrian had negative savings, right? He earned less than he spent, and there was that negative 5,000. And in Air Canada's balance sheet, you can see that is what is called the deficit, right? There was a deficit at the beginning of the year, right, the 31st of December 2020 of 494, meaning over the years of the life of Air Canada, there has been repeated losses, but the deficit has increased between the 31st of December and the 31st of March, because Air Canada continued to earn less than it spent, so that there was an increasing deficit. And as you can see, that increase in deficit, that increase in the deficit is why the total wealth of Air Canada decreased over the period, because it started off on the 31st of December, you want to call it the 1st of January 2021, with wealth of 1,715 million, and its wealth reduced to 904. And largely it's because it continued to operate at a loss. So we're going to jump now to Air Canada income statement to really understand a little bit more about how you go about interpreting operational activity. And this is really that statement that I produced for Brenda and Adrian that looked at their activity during the year, operations during the year. An income, sorry, Roger.
Yeah. So somebody just asked if you could explain just a little bit more in detail deficit.
Right. A deficit is just, if you think of what happened with Adrian and there was negative savings, right? That's what a deficit is, right? That you have earned, or let me put it this way, you spent more than you saved. You spent more than you've earned, and that creates a deficit. And and if you can, if you continue to do that year by year by year, it becomes a cumulative deficit, right? We looked at 1 year of Adrian and 1 year of Brenda, and we saw Adrian incurred a deficit or negative savings in 1 year. If we were to look at that, because I didn't have the time to do it, but if Adrian were to continue doing that year on year with nothing else changing, the following year, he would have incurred another deficit of 5,000, and his accumulated deficit would have been 10,000, right? And you would have seen, and what you can do, and maybe I can share these slides. What you could do is think of what would have been the impact on Adrian's balance sheet the following year if nothing else had happened except that he did exactly the same thing, right? His line of credit would have gone up by another 5,000. And if his line of credit goes up by another 5,000, it means his net worth would have gone down by another 5,000. And it's because of that accumulated deficit. I'm not sure who asked the question, Roderick. I'm not seeing the chat, but I think it's important. So if the person can let me know if they get it or not. It's an important question, and I like these kinds of questions when somebody is brave enough to ask, because it's really asking on behalf of a lot of people who might be struggling with the concept.
Absolutely. There's no such thing as a dumb question. So please do ask your questions in the chat and we will air them for you on your behalf. So yes.
It looks good to go on.
Yeah, I think we're good to go. Very good.
Okay. So even though we've not talked about it, I think intuitively, the mere fact that everyone was able, and I assume so because no one asked questions, everyone was able to calculate Adrian's deficit, let me use a word now, right, or Adrian's negative savings for the year, and Brenda's. We kind of know intuitively how to produce an income statement. Let me just formally now explain what a company income statement is made up of and some of the terms that are used. Revenues is what is earned during the period. And it's important, you know, to grasp the temporal aspects of what we've been saying, because I've said a balance sheet is at a particular date. It's like a snapshot. Revenue is something that's earned over a period. You cannot talk about revenue. Like you can't say my salary is $75,000. It matters whether it's $75,000 a month or a year or over a decade. So whenever we talk about revenues or any, you know, any concept that relates to income, it has to be, you have to define it by the period. So revenues of 5 million can only be interpreted by a temporal aspect. It's earnings for the year, or revenue for the month, revenue for 3 months, revenue per day. And that already gives you a sense of, it's a flow concept. It gives you a sense of the potential profitability. But just like assets can't be looked at in its own to get the full picture of wealth, to get the full picture of someone's profitability or propensity to save, one also has to look at their expenses. And like revenue, expenses can only be spoken of in the context of time. If I tell you that my cell phone bill is $100, I need to, you know, define that, because if I say my cell phone bill is $100 a week, you will say, Marcia, get a life. He's talking too much on the cell phone. If I tell you my cell phone bill is $100 over a year, it's like, Marcia, get a life. You know, I mean, so that, you know, not a very good example, but the point is, you know, you just can't see when you talk about expenses, right? Just as when you talk about revenues, it has to be contextualized. Is it $100 a month, $100 a year, $100 over a 3-month period? So again, you can only come up with a reasonable or a sensible number of savings, profit, any one of those terms, if you match the revenue for a period of time with the expenses incurred for that same period of time. And we can produce, typically, the word profit, when you look at an income statement or statement of operations, they call them all sorts of things now, of companies, the profit for the period. Again, it's not a static figure. Just like that, savings is not a static figure. That was savings for Brenda for the year. It was negative savings for Adrian for the year. In the same way, it is profit for the year by taking revenues for the year minus expenses for the year. Or it could be a 3-month period, or it could be a month, or it could be 5 years. It doesn't matter, but you've got to match the temporal period over which you're looking at the revenues with the expenses, which are costs incurred in generating the revenues. And the difference between those two is the profit. This is really an old-fashioned way of producing an income statement in many companies, particularly, and I shouldn't say old-fashioned because it's more popular in Europe and in England. It's not as popular in North America, where an income statement is produced basically this way. It's called the horizontal format, where you've got the revenues on the left-hand side, the expenses on the right-hand side, and the profit. And I want to backtrack a bit, because what I did produce to you was also, when we were playing with these boxes, was a balance sheet in the horizontal format. But you saw in Air Canada, it produced its balance sheet in a vertical format. In the same way, an income statement can be produced in a vertical format, taking the same blobs, revenues minus expenses, giving us the profit. So again, the concepts are the same. Just remembering here, the income statement is more like a flow. It's like a video. If you want to think about, if I'm to use the same sort of photographic media analogy between a balance sheet and an income statement, you could think of a balance sheet as a snapshot, whereas an income statement is more like a video. It tells you about what happened over a period, whereas a balance sheet tells you what things are at an instant in time. So again, these are the major items you want to look for in an income statement. Excuse me. And as I said, typically in North America, it's the vertical format that is used for the balance sheet, as you saw with the Air Canada balance sheet. And it's the vertical format that is used for the Air Canada income statement. And again, I've highlighted the major items that you want to look at. Total revenues. You can see total revenues for the 3 months ending March 2021 was $729. Let me just do one more click because this is looking too small here. 729 million. And what you could do is, again, try to make an assessment of, is this, how has Air Canada been impacted by the pandemic? already, and perhaps we should have looked at 2019, because of course, December, things sort of went south in March 2020. But if for the, actually, no, this is comparative 3 months. Look at what 3 months, March 2020, their revenues were 3,722 million, and the comparative or comparable 3 months in 2021 were only 729. I mean, that really speaks significantly to the impact of the pandemic, because of course the first 3 months of March 2020, we were not in lockdown. There was not a pandemic. And we look at the operating expenses. Air Canada is a company, so whereas for individuals, we just looked at expenses, they tend to categorize their expenses into operating expenses, i.e. those costs incurred in operating the business, aircraft fuel, wages to staff, and so on and so forth, all of the costs or expenses incurred in running an airline. But then there are non-operating items. So they've separated interest. You can see their interest expense. You can see foreign exchange gains. I think this is a good thing to talk about. They're not a bank, but they may have had assets in some other country, let's say cash, for example, and the exchange rate, let's say they had cash in the US, in a US bank account, and the exchange, the dollar to loonie exchange rate changed to the benefit of the money they had in the US, they would have suffered an exchange rate gain. And this is very much, when you look at, very much like how some assets could just increase in value, that's where they would have included in their income statement those assets whose value just increased due to market forces. So that would be non-operating income, that foreign exchange gain. Taxation, they did not incur a tax expense because they were making losses, so they had a tax recovery. So they treat that tax recovery almost as a negative expense. It's not really income, but it reduces their expenses. So that in totality, their expenses, and at the end of the day, this is what we're concerned about. Their expenses would have been the operating expenses plus their non-operating expenses, as I said, minus that recovery of tax expense, giving us a loss, that negative savings, if you want to call it, of 1,304. Where am I in terms of time, Tika?
While you wait on that time counter, Doc, I was also looking at how the revenue change, the rate of change of the revenue compared to the rate of change of the expenses.
Exactly.
The revenue is going down much faster than the expenses.
We're at 11:08 right now.
How much time? I never remember how much time I have. I don't like to keep the time in my mind because.
What, 10 more minutes? If that's
okay, that's good.
Okay.
And you could see Mike is an accountant because he anticipates everything I'm gonna talk about. So one of the things. So now that we sort of oriented ourselves to the income statement and the relationship between the income statement and the balance sheet, I just want to recap. For the 3 months, 1st of January 2021 to 31st of March 2021, in simplistic terms, Air Canada spent more than it earned. It incurred more expenses than the revenue that was generated. Air Canada was very much like Adrian. And therefore, for that 3 months, Air Canada incurred a deficit for that 3 months. There had been prior deficits, so that its accumulated deficit by the end of the 31st of December, sorry, the 31st of March, would have been greater than the deficit just for the year, because it had been making deficits before. And every year it continues to make deficits, its wealth reduces. And as I said before, we can explain 2 statements of wealth. A huge explanation between 2 balance sheets is the income statement, or the consolidated statement of operations, as Air Canada calls it, that takes place, that explains what has taken place between the 2 balance sheet dates. So that helps us understand how to interpret a balance sheet. We kind of have some basic understandings of how to interpret an income statement, and we have some basic understandings of how income statements and balance sheets relate to each other. And really and truly, when you bring it down to simplistic terms, it's really one is a statement of wealth, the other is a statement of what did you do to increase or decrease wealth. And you typically will end it with another balance sheet and says, here we are. This is where you were at the beginning of the year. This is what you look like. This is what you did during the year, the income statement, and this is what your wealth is at the end of the year. Now, in closing, therefore, I want to get back to the point that Mike made, which is, let's now go back and look at Air Canada's income statement, because there is something about the nature of your expenses that can strangle you in terms of wealth creation and wealth diminution. We saw that the nature of your liabilities can, but the nature of your expenses also can, which is something I didn't touch on because I did not want to overcomplicate life. And one of the things, the points that Mike has brought out is that when we look at the 3 months, 2020 and the 3 months, 2021, we see that even though revenues went down substantially for Air Canada in the 3 months, the COVID, pure COVID 3 months, 1st of January 2021 to 31st of March 2021, there was not a commensurate decrease in their costs and their expenses. One would think if we cut operations by, some 80%, maybe we should be able to cut our costs by 80%. And some costs can be cut. As you can see, aircraft fuel was substantially cut. Because if you're not flying, you're not earning revenue, you're not spending on fuel. That's what is called a variable cost. It's a cost that moves with activity. So you increase activity, costs increase. You reduce activity, costs are reduced. But there are some costs that are fixed costs. And regardless of whether your activity increases or reduces, those costs remain the same. And a typical example, so we have right after each other, two costs that move fairly differently with activity. And you can see that the wages and salaries, yes, they went down, but not the way aircraft fuel went down. Our aircraft fuel went down. It's probably one quarter of what it was last year, because our revenues are a quarter of what they were, but our wages and salaries and benefits could not, because the pilots are not flying, but we still have to pay them. So this brings in another aspect of, and it's really, fairly relevant to companies, and it's something that you have to look at, is the cost structure. Because the cost structure of a company, if its major costs are fixed, it means that if something that is outside of the control of the company, a pandemic, right, that has an impact on the company's ability to earn revenue, and its revenue shrinks, the company does not have much room to maneuver in terms of reducing its costs, because its cost structure is made up of so many fixed costs. And I want to end here with something that I have had to tell our students, and many of you are parents and so on, and our students at university, because there's been a big furore with, many of the parents, many students, okay, we've got a pandemic. We did not want our students to come to university doing online. We want a reduction in tuition. If you think of a university, its major costs are fixed costs, salaries to professors, so that even though we've had to pivot to online, our costs actually went up, because to pivot to online, we've had to increase costs in terms of software, new kinds of technologies to facilitate online learning. Salaries have remained the same. And in fact, in many cases, salaries have gone up, because some university staff have had to work more overtime. So that the clamor for tuition reduction, to a large extent, fails to understand, one, that for universities, their major costs are fixed. So that even though we've pivoted to online, our expenses didn't go down. And in fact, contrary, our expenses have gone up. So I end there with a very real example, because, I've had to sit many students down and said, what about bringing your accounting knowledge to bear to understanding what has happened to the tertiary sector in the context of COVID? Because we operate with a huge, huge fixed cost structure that limits the ability to cut tuition, because that could actually lead to the demise of the universities. So I'm going to end here and, perhaps open up to, do we have time for questions? Are there questions?
Yep.
I'm not, and maybe I should stop sharing now. Yes, and I actually ended.
All right.
I've never seen this before.
Okay. Okay, yes, so we do have some questions here from our audience. So first we have Mona. Mona, you had a question? And before Mona, you ask your question, if anybody does have a question, please raise your virtual hand and then we will get to you momentarily. So Mona, you're on.
Good morning.
Nice to see you again, Mona.
Thank you. Actually, my question, I posted it in the chat, but you didn't get a chance to see it. It has to do with Air Canada. I was wondering if Professor Annisette, if you've had a chance to compare Air Canada with another airline in terms of their practice to see what's the difference, and just so that we can have for comparison purposes, what maybe some of the issues or non-issues and vice versa. Thank you.
That would be, I wish I had 10 weeks because, that is something I would really like for us to do, get Air Canada and WestJet, because in the same way, or another airline, in the same way we could look, we looked at Adrian's balance sheet and Brenda's balance sheet, right? We could look at, and this is how financial analysts work. They look at companies within the same industry and look at asset structure. They look at financial structure, right? We looked at that. We compared the financial structure, in a sense of Adrian and Brenda. We looked at the liabilities side and were able to make certain assertions about, who had a more risky, less risky. And that's what financial analysts do. If we had the time, I would have done it. I would have brought up several other balance sheets of airlines to sort of make the same kinds of assertions. But you now can do it. And similarly, and that's just looking at financial structure, right? Exactly what we did and made certain assertions as to why we felt Brenda's financial balance sheet was better, even though her net worth was lower. Similarly with income statements too, right? You can look and see who managed their assets better. It may well be, for example, whereas Air Canada has more staff that they hire permanently, and therefore their cost structure is made up of fixed costs. WestJet, for example, may have their staff, like their pilots and so on, casual. If you don't fly, you don't get paid. And therefore, with that cost structure, if WestJet's revenues suffer an 80% decrease, we may see a far closer decrease in wages for WestJet than we've seen for Air Canada, right? They're better able to navigate the decrease in activity because they can better manage the cost. So that is a brilliant question, Mona. And it is, maybe you're an accountant too, because you're kind of anticipating, or if not, you have a
lay accountant. Lay accountant.
Lay accountant, but no. Those are the kinds of, that's the kind of thing that you want to do now. Mm-hmm. Right? Look at cost structure, how your cost structure can allow businesses to navigate the vagaries of business. And for those of you, and I think this is an important point, for those of you who have businesses, right, it's important really to understand the relationship, your cost structure, your fixed costs versus your variable costs, in terms of how those costs can really, constrain you in very risky and uncertain times. Somebody has asked, wouldn't that flexibility
be based on existing terms and conditions and union relationships? I mean, I guess that would definitely have something to do with it too.
Yeah.
All right, we're going to get to a couple more questions. So we have Fedor.
Can you hear me, guys?
Yep.
Hey, I just want to say, Professor, I'm going to say, you're dropping some real knowledge. It's amazing. Thank you. I just want to ask something, then I'll ask my question, is that every organization that you know is run like a business, whether that's a union, whether that's nonprofit, whether that's a corporation, they're all run like a business. So my question is, not in terms of corporations, but in terms of just compound interest. So as a student, right, who wants to have the discipline to save money, how can I and other people compound interest in daily savings? If you can just talk about that and just to what we've learned from, that'd be amazing. Thank you.
I'm sorry, I think it broke up, but if it is you're talking about compound interest and savings and so on, I would like to leave that for the session next week, where we're talking about cash management. I don't think it was just me, but you were breaking up. Am I right, Roderick?
Yes.
But I was only able to capture compound interest and borrowing and so on. And we spoke a bit about that in the class on liabilities. But when I bring Joel in next week, I want him to focus more on that. Can we move on?
Okay, so we're going to go to Sankofa.
Yes, good morning. See, the professor said she didn't want much input, so I stayed quiet till the end. So, Professor, here's my trick. Air Canada is part of a sector. They're like a quasi-government body. They were given a loan from the Canadian government that is a sweetheart deal, like a kind of a bailout loan. Part of the issue with Air Canada often is they seem to depend on that guarantee. Porter is getting some loan like that, but I'm not sure the other airline gets those loans. And they were also going to use some of that money to pay big bonuses to their executives, and it was frowned upon. But the government also made stipulation in that loan that they must refund some of the people who paid for trips. Could you talk about certain arrangements? Because we are the auto sector also was given loans, certain, I don't want to call it sweetheart deals. That's not laissez-faire economics. That's not capitalism, is it?
No. It's convenient capitalism. We don't even have to talk about now. We could talk about the 2008 financial crisis when, all of those big banks went bankrupt and they were bailed out, and car manufacturers, they were bailed out by the governments. That goes, you're quite right, that goes against all of the principles of laissez-faire capitalism. But what has happened through laissez-faire capitalism is that you ended up with institutions that were too big to fail. That became the mantra of the times, that the financial implications on everybody if these institutions fail. And one isn't going, that could be a justification for helping them out, as opposed to helping out Main Street, as opposed to Wall Street, the big banks. So, we see a return of that in terms of bailing out big business, but that less has to do with financial statements and more has to do with politics, political economy. So if the question is bailing out, whether bailing out financial institutions or any other institutions is consistent with laissez-faire capitalism, the answer is yes, it's not consistent. Laissez-faire means let the market prevail. I think a pandemic is different, right? A pandemic is different from what happened in 2008, because 2008 was really a market phenomenon. The pandemic is you know, you know, it was not created by a market set of actions, right? So, you know, the idea is not too big to fail, but the idea is that, oh, my son is only now entering. The idea is that we, you know, we got to salvage the economy. We got to salvage, you know, individuals, because it's not just businesses which were, you know, given support during the pandemic, but also individuals who lost their jobs and so on. So, you know, to me, this is now really, you know, the welfare state coming in and saying, look, you know, we've got to, you know, help all of the constituencies. Again, whether the welfareism showed bias to certain constituencies, more preferable treatment to some constituencies than others, again, takes us into the realm of political economy.
All right. On that note, we just wanted to say, again, a thank you on behalf of the BBPA and all of the guests with us today. It's always an opportunity to learn. And as I said at the beginning of the session, when opportunity knocks, please answer. It doesn't always knock on an ongoing basis, but when it does knock, like it does for the last weeks with Dr. Annisette, please answer, please ask the questions. Please just don't keep this information for yourself. Reverberate it throughout our community so that not only us on this virtual learn, but so do our families, our friends, and our colleagues. So please, please, please share the information, and don't forget to tell a friend that every Saturday at 10 a.m. we're here live on Community Spaces, the virtual financial literacy program that speaks the language of the community. Tika, any last words? Oh, I think she may be. Michael, any last words?
As per usual, excellent presentation, Doctor. And I just want to say to the folks that are on the chat right now, remember we did econ in the first 4 weeks and we did marketing the next 3. And remember, the world is not discrete little bundles all over. The question that was asked by, you know, Kansofa, and the doctor explained that it was political economy. We did that back in the first 4 weeks. Mm-hmm. So we have to always remember to make the links, because it's one big world with different little disciplines, but it's one big world. So here you'll see how the accounting will come in, how you monetize the political decisions and how you reflect them in the books and records, and whether it's generating wealth or it's destroying wealth. So again, thanks very much, Doc. I'm just learning how to teach accounting again as I listen to you.
All right. All right. On that note, take care, everybody. Stay safe. Even though that the province of Ontario now is in stage 3, still take precautions in everything that you do, and we will see you back next week. Take care. Thank you very much, Dr. Annisette.
Bye. Thank you.
Bye-bye.